The stock market looks great. So what could go wrong? In today's video, I'm going to show you how all the signs point to a healthy stock market. But there are a couple of things that could cause a problem. What looks good so far? So if we look back over the past week, you can see that the riskiest investments, ARK Invest, handily outperformed the NASDAQ 100, still kind of risky. Handily outperformed the S&P 500, safer. Handily outperformed small caps, who knows, and handily outperformed the Dow, safest. This is a very healthy stock market rally. What about over the past month? If we look back over the past month, same story. ARK Invest handily outperformed all of the others with a 36.27% return, followed by the NASDAQ 100, followed by small caps, followed by the S&P, and followed by the Dow. This again is a very healthy stock market. And I want to look back over the last 6 months just to kind of give you some perspective. So the market clearly bottomed out back here, but you can see since then, ARK is on a much steeper slope here, and the NASDAQ 100 is on a steeper slope than these other safer investments, especially the Dow, which looks flatline compared to these. So this is again a very healthy rally. I messed that up. Sorry. I need a drink. Good. Okay. So you can see here how there was almost a bottom confirmation here. We didn't quite get there, but you can see there was already a nice rally underway. And since that time, the bottom confirmation signal has been dropping. The bottom forming indicator has been rising. But what concerns me here is the confidence level is rising. So if this bottom forming indicator keeps going higher and this confidence level keeps going higher, we could be in for a little bit of trouble. Nobody knows how much though. And let's take a look at equities versus safety, because this gives us a really good picture of what's going on in the markets. So if we look back on January 6th, 4 weeks ago, you can see gold, cash were in first and second place here in the rankings. IWM was creeping up, which is good. And TLT and EDV were starting to move up, so we were starting to see a little bit healthier Treasury market. But the NASDAQ 100 was all the way down here at 10th, so it was not in a good place. Now you can see 1 week later how the NASDAQ jumped up to third place, IWM in first, gold in second, and the longest term treasuries, EDV, were in fourth place. So this order is very healthy, with TLT, EDV ranked above cash, intermediate treasuries, and T-bills. Now, a week ago, we had a very healthy stock and bond market. The NASDAQ 100 in first, small caps in second, gold third, long-term treasuries in fourth, SPY in fifth, and so on. Now, in my last video, I mentioned that Dow was ranked 10th. So you'd think, oh God, the equity markets are awful. No, this is really good because people were taking their safe equity investments and moving them into riskier investments. This is a really good initial action to happen at the beginning of a rally. And now where are we as of this last Friday? Well, you can see NASDAQ 100 first, small cap second, SPY third, Dow's moving up. So more conservative investors are starting to put their money back into equities. They're putting them into the safe equities, into the Dow. And you can see that the longest term treasuries, EDV, are ranked right here, right behind the equities. So this is a very healthy stock and a very healthy bond market. Now, what could happen down the road? Well, as value investors see these risky investments coming up, they're starting to put money into the safe equities because they're risk averse. So if they're going to go into equities at all, they're going to put them in the Dow. And how does this show up in the buying and selling pressure? Well, you can see right here, the Dow Jones Industrial Average buying pressure is shooting up really quickly here. And we've had a nice rally since this bottom. The S&P 500, same thing, even a steeper slope. The buying pressure is shooting straight up. The S&P 500 buying pressure is just slightly higher than that of the Dow. They're almost about the same, but what I like is the S&P 500 is shooting up much quicker here. What about the NASDAQ 100? Well, it's interesting because the NASDAQ 100 has been on one heck of a rally here, one heck of a tear, and the buying pressure is below that of the Dow and the S&P 500, but it is shooting up very nicely here. And what about small caps? Again, a very nice rise in the buying pressure. a very nice rally going on, and things look pretty good here. And what about ARK Invest? Same picture, almost identical. Buying pressure shooting up, very nice rally. Now I'm going to show you a chart I don't think I've ever shown you. And this is a way that we look at the level of risk in the market versus the level of opportunity. So the black line is the S&P 500. The red line is the equity risk level. So the higher this is, the worse off the equity markets are. And the green line is the equity opportunity level. So the higher this line goes, the better off equities are. And how does that show up? Well, you can see back here how the risk level shot up, the opportunity level fell, and what happened? The S&P fell. And while it was falling, the risk level in general was trending lower. Now we got down to here, and I will tell you, this is a very early indicator to tell you to get out of the way or protect your portfolio. So you can see that back here. This opportunity level is a late indicator, and you can see that here. The market turned actually back here, started going higher, and this didn't start really turning higher until very recently. So this is a late indicator for getting back in. This is a relatively early indicator for getting out of the way. So what this tells me is things look pretty good right now. And what if we look at the best sector rankings? So we looked at these in depth last week. I'm not going to go into that much detail this week, but you can see the energy is ranked first. Materials, the way they've defined them, are ranked second. Technology, semiconductors third. This is very healthy. This is a very healthy risk appetite. Aerospace and defense fourth. Industrials fifth. Emerging markets, and so on. And you can see that cash isn't anywhere to be found on this table. This is very good. And by the way, you've got emerging companies, emerging markets. These are all risky areas to be in. The fact that they're here in the top ranked sectors shows us we have a very healthy appetite for risk. So let's look at this week's worst sector rankings, and this also tells a story. And the big story here is that cash is way down here near the bottom of this pile. Now you'll say, well, ARK and clean energy and Bitcoin are also down at near the bottom, but these move fairly slowly, and these are moving up, especially Bitcoin. Bitcoin was dead last, I think, either last week or the week before, and now look how it's moved up. So Bitcoin is on a very healthy rally right now. So what if we look at rank acceleration? In other words, how quickly are these different sectors changing ranks, either going up or going down? Now, this is looking at last week, and you can see that materials, energy, and technology, semiconductors were 1, 2, and 3. Cash was way down here. What I do like about this from last week is that Bitcoin was way up here, and ARK Invest was here. Not a bad place to be. Well, how does this look this week? So if we look at this week, you can see that SOX technology has moved up into the number 1 spot. We've got emerging markets, emerging companies. These are all moving up very quickly. And what I really like here is that consumer staples is now near the bottom in terms of how its ranking is accelerating. And consumer discretionary has moved all the way up here. And I love the fact that cash is right down here near the bottom. This is just great. So let's take a look at what's happening in the Treasury markets. So you can see here that this is a very healthy market, at least for the week it is, although these longer-term Treasuries both are trending down over the last 4 days. But they finished the week with the highest risk, longest-term Treasuries in first place, 20-year TLT Treasuries in second place, and so on. So this is still a healthy market. But we'll talk about what can happen here and what the risks are. If we look at intermediate treasuries, you can see that the selling pressure is moving higher and it's well above the buying pressure. If we look at this yellow line, these are the 3 to 7 year intermediate treasuries, and you can see that the price has been declining since about 3-4 days ago. And that's showing up here in this graph. You can see that the price has been somewhat declining, but well before this peak, the selling pressure was above the buying pressure. If we look at what I call intermediate to long treasuries, 7 to 10 year treasuries, same picture, dropping price, increasing selling pressure. And what about long bonds, 20-year treasuries? Well, we had a very nice rally going here. Buying pressure was well above the selling pressure, and now it has collapsed. and the selling pressure is moving higher. So we'll have to see what happens with this. But I'm going to talk about what those concerns are that I have in the market after I finish this analysis, and we'll discuss how this might affect the equity markets. One of the things that we have to take into account is we're currently in a situation where we have an inverted yield curve. And what does that mean? Well, it means that longer-term treasuries, in this case, the 10-year treasury yields, are lower than the 2-year treasury yields. So if we subtract the 2-year from the 10-year yields, we get a negative number. This is an inverted yield curve. So what has to happen in order for this yield curve to become not inverted? Well, that's going to lead us into what my concerns are for the markets. We'll talk about that once we go over gold and Bitcoin. So how does gold look? Well, gold has really been on a nice rally here. It's really had a nice run. And you can see the buying pressure was well above the selling pressure. But if you look at the 1-month trend here, it's now declining. And in fact, the buying pressure is just touching the selling pressure and moving in a direction that's not good. So we'll see where this goes. And what about Bitcoin? Now remember, these are the riskiest assets you can invest in, and other than options and futures. But you can see we've been a really nice rally here. This has gone from less than $8 a share to over $12 a share. That's better than a 50% increase in a very short amount of time, 1 month. So what's giving me concern about the equity markets? Well, there are really 2 reasons. As I mentioned earlier, the yield curve is still very inverted. And for that to correct itself, 1 or 2 things have to happen. And what are they? So the first one is that the yield on longer-term treasuries would have to rise significantly to go above the yield on the short-term treasuries. And this would cause the bond prices to fall significantly. The other thing that could happen, either by itself or in concert, is the yield on the short-term treasuries would need to fall below that of the long-term treasuries. Now, the Fed controls these rates. So if the Fed were thinking that we're running into a recession and they were to lower the rates, this would cause the yield curve to not invert anymore. The other concern I have, so the second concern I have, is that investors have this common wisdom that if you made a lot of profit, you better sell it, you better rebalance it, you better cash in your gains. That's a fool's errand. Now, as I discussed in the video linked in the pinned comments below about why most money managers and individual investors will never beat the S&P 500, why is this? Because rebalancing too much or too often minimizes your gains and doesn't help you at all with your loss characteristics. So why could treasuries hurt the markets? Well, a drastic rise in the long-term treasury yields could hurt the equity markets because as the yields go up, these are safer than equities, and they could cause equities to look less attractive, causing investors to sell equities and buy treasuries. On the other hand, a drastic decrease in the short-term yields could cause the equity markets to rise significantly because it'll be a signal that the Fed is done raising rates. Where does this leave us? Well, my advice is to stay put until the metrics that I presented earlier show a totally different story. Right now, the equity and risk markets are on fire. Enjoy the ride while it lasts. I'm Calvin Rose, and thank you for watching Invest Smarter today. That's all for now.